Thank you guys for clicking on today's video. Today we're going to go over how the stock market actually works. So a good way to explain how it works is actually by giving an example. I'm going to show you guys how a small car dealership that is trying to grow their business works into the stock market. So let's say this car dealership wants to not only expand to more locations but also develop new products. So they go to a bank. However, the bank declines their loan for a certain number of reasons, whether they don't have enough equity, they don't believe their company is going to continue, etc., etc. So this mom and pop car dealership decides to go on the New York Stock Exchange. They do this through an IPO, or an initial public offering, which basically means they are now going from a private company to a public company, allowing people to buy equity into their company, making them a partial owner as well. So this car dealership goes into the New York Stock Exchange and offers a certain amount of shares. They then allow those shares to be bought up by anybody. And now those traders decide that they really believe in this mom and pop shop and it's a great time for the car business. So they go ahead and they buy up equity into their company. The mom and pop shop has now raised enough funding to start developing new cars and expanding into new locations. They do this because it's a lot faster to raise money from outside sources instead of trying to sell as many cars as possible. They then start taking their newfound money and expanding, making the shares that were originally bought more valuable since the company is worth more now, and equity in their company is now priced at a higher range. Now, what a company can do is when they have extra money, they don't have to do this, but they can pay out a dividend to their customers, or basically just giving their shareholders free money. Now, the reason they might do this is to, one, reward their shareholders, and two, to entice other people to buy more of their shares as well. This is called a dividend. Now, on the contrary, let's say the company is doing bad and they need more money and things didn't go as expected. What the company can do is they can do a follow-on offering, which basically means that the company is offering more shares for the public to buy, making the original shares diluted and less valuable since there are more shares available to be bought. Likewise, if a company is doing great, they could do a buyback and buy back more of their shares because they feel their company is doing better and they want to retain more of their equity. And by doing this, it creates a little ecosystem for money and equity to exchange between people. People can buy stocks planning on the company expanding, making their current stocks more valuable, making them money, and the business more money since they got to expand. And on the other side, they can both lose money with the company having to offer more shares and with the original investors making their shares less valuable, creating the stock market. So I hope you guys enjoyed the video. Please leave a like, comment, subscribe for more future content.